I'm gonna teach you the first trading model that my father taught me when I first started out 5 years ago with zero experience. What he taught me was so simple and powerful that I was able to start making money only 3.5 months into my trading journey. And even to this day, I use this same exact framework every single morning because it works. In the last 7 months alone, it's made me a little bit over $430,000 day trading stocks. And I'm actually in Portugal right now trading off a lousy Wi-Fi connection, and I was able to make $600 on Monday, $2,700 on Tuesday, and $5,200 on Wednesday, which essentially paid for my entire vacation. By the end of this video, you'll know exactly how to apply this framework into your own trading, how to scan for these massive moves, and how to capitalize on them with confidence. This video can genuinely change the way that you trade, so I highly recommend watching until the very end. And I'm not saying that for me, I'm saying that for you. This video is a game changer. Let's hop right into it. Change of scenery here. The hotel kicked me off the terrace because they knew about the value I was about to drop. But in this video, I'm going to explain what the gap trading model is, how it works, why it works, how to apply it within your own trading starting tomorrow, how to scan for these massive moves that I'm about to show you, and how to take advantage and trade those moves using predefined simple setups that even a beginner could take advantage of. And if you haven't realized it yet, I like to keep my trading as simple as possible. And this model is incredibly simple. It's not complicated. It's not complex. It's very easy to understand, as you're about to witness. But the real sauce is applying it correctly. There are details, there are nuances that are important to understand to find high probability trades on high momentum stocks, right? I, as a trader, pass on like 98% of the opportunities in the markets. I only focus on high probability, high quality. And you have to differentiate yourself from all of the other traders who take low quality setups. There's a lot of traders who trade gaps, who are kind of familiar with this model, but not a lot of them succeed because they focus on low quality gaps and low quality setups. But that kind of begs the question, what is a gap in the first place? So if you search up on Google, what is a gap in trading, you're going to get this definition. So feel free to pause the video and actually read this definition, but I'm going to simplify it even further. A gap is an overnight change in price. The stock market closes at 4 p.m. Eastern on weekdays, and it opens the next morning at 9:30 a.m. Eastern. So all of the price activity that happens overnight, whether it's buying or selling, that price activity is reflected the next morning as a gap. So let's say a stock closes at $5 at 4 p.m. Eastern on Tuesday, and then the next day on Wednesday, when the market opens at 9:30 a.m. Eastern, the stock opens at $8. That $3 difference in price is called a gap. So it's just an overnight change in price because there's trading activity that occurs either in the post-market or the pre-market. And these gaps occur because of news, because of earnings within the company, like positive earnings or negative earnings, or events in the company, or maybe there was a new law that was passed where that affects the company. And as a result, investors either panic or they get really excited during the after hours trading, and that causes the stock to gap and change in price overnight. However, it's very important to understand that we don't care about the news. I'm not sitting there every morning and reading earnings reports or reading the news about why that stock gapped or why, the investors panicked. I don't care about any of that. All I care about is the price action. What effect does that gap have on the charts? So let's go ahead and look at some examples so you could literally visualize what a gap is, and you could literally see the gap in price on the chart. It's not really important where the price was for this example or what day this was. I'm just trying to prove a point here where we closed right here on the previous day, and then the next morning we opened up here, and you could literally see the gap in price on the chart. And that's exactly what a gap is. It's an overnight change in price. This was on J&J just a couple of weeks ago where we closed right here, and then the next morning we gapped down and we opened right here, right? You could literally see the gap in the chart. So we have gap ups and we also have gap downs, and these were pretty significant gaps. But take take a look at this one. This one was actually a pretty small overnight change in price. And always remember, the amount that it gaps isn't really relevant. What we care about is where it's gapping to on the charts, and we're about to talk about that in just a second. But right here, we closed at this price the previous day, and then the next morning we gapped up right here. And like I said, you could literally see the gap on the charts. And it's really simple. A gap is just an overnight change in price. So before I teach you how to identify high quality gaps and how to trade them step by step, it's very important that I debunk a very common misconception and myth that I always see, that all gaps fill. And this is complete nonsense. A lot of traders will tell you this, but it is not true. And what a gap fill is essentially when the price of the stock returns to the price it was the previous day. So let's say a stock on Tuesday closes at $5 at 4 p.m. Eastern. And then the next morning on Wednesday, it opens at $8. A gap fill would be where the stock opens on Wednesday at $8 and then drops back to $5 and just goes back to the original price it was the previous day. So for example, like on J&J, we closed right here and then the next morning we open here. This is the gap. A gap fill would be where when it opens on this day, it just goes back to the original price, right? Or for example, right, let's take it on Chegg right here. We closed here and then we opened here the next day. And instead of moving up, a gap fill would suggest that it would drop back down to this original price, essentially where it was the previous day. And that's what a lot of traders will tell you. They'll tell you that all gaps fill, and you shouldn't really focus on gaps because they all fill. But that is nonsense. And the reason I know that is because I trade gaps for a living. I do this every single day. I've done it every day for the last 5 years. And 90% of the time, I am looking to trade in the direction of the gap. I trade the continuation of the gap. So if it gaps up, I'm looking to go long. If it gaps down, I'm looking to go short. Now, there are exceptions to this where I'll go for the reversal, where if it gaps up, I'll be looking for a short, or if it gaps down, I'm looking for a long. But those are pretty rare. And yeah, it's like 5 to 10% of the time. 90% of the time, the majority, I am trading in the direction of the gap. And you might be wondering, why do I trade gaps in the first place? And it's very simple. Gapping stocks move way more than non-gapping stocks, and they just have way more momentum. And as a day trader, I want to trade stocks that have a high probability of moving 10, 20, 30, 40% in a single day. And the gap is like a catalyst for that stock. I like to trade stocks that have a catalyst because the catalyst causes it to just move way more than non-gapping stocks or stocks that don't have a catalyst, right? So it's very simple. Gapping stocks just have a higher probability of moving and having momentum in one direction. And they also provide me a clear bias and direction in which I should trade in, right? Where if it gaps up, I'm looking to go long. If it gaps down, I'm looking to go short. It gives me what the trend is. It gives me that bias in which I should be trading in. So let's get into how to trade gaps for a living step by step. And step number one is finding gaps in the pre-market. So every single morning at 8:30 a.m. Eastern, around 1 hour before the stock market opens, I begin my morning preparation where I go to my trading office and I begin scanning for gaps. And what you're essentially scanning for is percent change or percent difference between yesterday's closing price and today's opening price. And there are a bunch of different tools, scanners, websites that could actually help you accomplish this, and they're 100% free. And I'm also going to show you the specific site that I use every single day to scan for gaps. Now, the first website that you could use is finviz.com, and this is actually a really popular site for traders and investors, and I have used it in the past to scan for specific stocks. Now, I don't use Finviz for my current scanning right now. I just want to give you different options and different tools that you could play around with to see what you personally prefer. But don't worry, I'm going to show you exactly how I do my pre-market scanning to find gaps every single day in just a second. But once you're on finviz.com, and by the way, this is also a free site, so I want to show you free websites that you could use so you don't have to pay for anything or you don't need to sign up for a specific brokerage that may or may not be available in your area. So once you're on finviz.com, just click on screener right here, and it's going to bring you to this page. From there, navigate to technical. And if you click on right here, gap, if you kind of hover over it, it'll tell you the difference between yesterday's closing price and today's opening price. Now, it might not show today because it's Saturday. However, if you click on that, you could scan for all gap ups or you could scan for all gap downs. Now, they also give you functionality of like specific percentages, but I don't see how that would be useful. I would just scan for all gap ups and all gap downs. The next site that is super useful is marketchameleon.com. And once you are on the site, you just hover over to stocks and then you go to features, pre-market trading. Just click on that. And this website actually gives you a big list of overnight gap ups or overnight gap downs, where it gives you this list of gainers, percentage change, and it'll list them in descending order based on the biggest gap ups all the way to the smallest gap ups. And then for the decliners, the same exact thing. It gives you the biggest gap downs all the way to the smallest gap down. So you could literally just copy and paste these tickers onto your watch list every single morning. And there's other really cool functionality with this site. It'll give you the most active tickers traded that day. And sometimes I do kind of scroll through Market Chameleon during the intraday. For example, if I want to see like the top gainers on high volume, and I'll just kind of see what stocks are popping off that day. You could also use tradingview.com, where you head over to products, you go to screeners, and then you go to stocks. Now, I haven't actually used TradingView, so you guys could experiment and let me know if it works or not. But if you go to extended hours, it'll actually tell you pre-market change percentage or pre-market gap percentage. And then you're able to sort by ascending order or sort by descending order. And it'll give you a bunch of stocks that have overnight changes in price, whether it's a gap up or a gap down. Now, in terms of what I personally do every single day, I do most of my scanning on my actual Think or Swim platform, just because it makes it easier for me. So whenever you're on your watch list on Think or Swim, if you right click this thing right here, go to customize, you could actually look for percent change or percent change since or percent in the money, or this wouldn't make sense, but percent change. I like to use mark percent change. I found that to be super useful, but you can kind of experiment. Sometimes I use other ones, but this is what I would do. You can kind of go to this column and type in percent change, and it'll give you a bunch of different options. And this is exactly how I scan for gaps every single morning. It's usually a combination between Think or Swim and using percent change or mark percent change. And then I also use Market Chameleon in case I like missed out on some gaps, or maybe my scanner on Think or Swim didn't include some. That's exactly what I do. Step number 2, now that you have your gap list, you have that list of stocks that are either gapping up or gapping down. Now it's time to assess the quality of every single gap and pick the specific stocks that you want to focus on for the stock market open and throughout the trading day, because you may have 20, 30, 40 stocks on your gap list, sometimes less, sometimes more. It really depends on the time of year. For example, during earnings season, when companies are reporting quarterly earnings, they usually report either in the pre-market or in the post-market. So we have tons of gaps during earnings season, and that's why earnings season tends to be a really busy time of year. And you don't want to overwhelm yourself looking at like 20 different gaps. You want to pick, the specific gaps that you want to focus on for the market open. And there are specific criteria and qualities that separate high quality gaps from low quality gaps. And I'm about to teach you how to do that. But first, you need to check the price in which the stock is gapping to. So for this, depending on what brokerage you use or what scanner you use or what platform you use, it's going to tell you where it's gapping to. Like, what's the pre-market price of that stock? And that's what you're going to look at. And from there, you're going to go to the daily time frame on whatever platform you are using, and you're going to look on the charts, where is the stock gapping to? So for example, on Apple, we closed on Friday at like $200. If Apple opens at 190 versus let's say 173, that is a massive difference, and that could have massive implications on the quality of the gap. So it's important to identify the location in which the stock is gapping to, because it could have a dramatic impact on the quality of the gap. So it's very important that in the pre-market, you're looking at the daily chart, you're looking at the pre-market price, and you're checking where the stock is gapping to. Now it's time to learn about how to assess the quality of every single gap that you look at so you can pick which stocks you want to focus on for when the stock market opens and throughout the trading day. And this is by far the most important component of your gap scan and your pre-market analysis. You need to identify the high quality gaps versus the low quality gaps. And this is really what's going to differentiate you from all of the other gap traders out there. This skill set is beyond important when it comes to pre-market scanning and then even intraday scanning as well. So let's keep it simple, right? So even if you're a beginner trader, you're going to be able to understand everything that I'm about to talk about. We are looking for gaps that, number one, are clearing directly above a resistance area if it is a gap up. Remember, I like to trade 90% of the time in the direction of the gap. So if it's gapping up, my bias is to go long during the intraday timeframes. For that case, we want it to be gapping above a resistance area. We don't want it to be gapping into resistance. We want it to be clearing and gapping above that resistance. And I'm going to break down exactly what that means in just a second. I just want to kind of go over all of the points real quick, and then we're going to go into the specifics. And the opposite applies if it's a short. If it's gapping down, my bias is to go short. I want it to be gapping below support. All right. I want it to be clearing a key support area. So that's the first thing we're looking for. Number two, we look for gaps that are either ending a long-term or short-term trend, or that are surprising buyers or sellers, or shocking buyers or sellers, or even trapping buyers or sellers. And this is so powerful. I'm going to show you how this works. These are the most powerful gaps that you could possibly find. Gaps that end trends and that shock buyers or sellers. We also like gaps that trigger high time frame setups off the daily time frame or off the weekly time frame. And we also like gaps that have room to move. So let's say we're clearing a major resistance area. We want to make sure the stock has room to actually move up before it hits the next resistance area. So these are all the points we're going to look for. And now let's get into the details. So off the bat, let's start off with support and resistance requirements. So let's break this down. We have a very established downtrend, and then we begin consolidating at the lows, and we close right here the previous day. The next morning, we gap down, and notice how we are gapping down beneath this consolidation. We're gapping beneath this area of support, and that's exactly what you're looking for. You don't want it to gap into the consolidation. You want it to gap underneath support, underneath the consolidation. So it's actually clearing every single low, right? You want it to be opening below every single low right here. And that would effectively mean it's gapping below support. Same thing applies if it's above resistance. Established uptrend, and then we begin to consolidate at the highs. We close here the previous day, and the next morning we gap up. Notice how we're not gapping into the highs. We're gapping over the highs. We are clearing these highs, right? So we're gapping above that resistance area, and that's exactly what you want to look for. Now, another really key point is that notice how I said directly above resistance. I didn't say a massive amount above resistance. I said directly above, right? So we don't want massive gaps above resistance or below support. A lot of people think that the bigger the gap, the better the gap, and that's not necessarily true, right? So let's say instead of us opening here, we opened all the way down here, way below support. We don't want that, right? We want it to be gapping directly below support, not like crazy far away from support. Does that make sense? Next, instead of it opening directly above resistance like it is here, imagine it opened all the way up here, which, has a massive distance between yesterday's closing price. It's way above this resistance area. We don't want that. We oftentimes actually call these mega gaps when the gap is so big that it almost loses its power. It loses its effect because it's just completely gapping off of the charts. And a lot of the investors, right, like imagine you were in it short right here and all of a sudden it gaps all the way up here, right? You might like panic sell, but you might also just be like, okay, well, I'm just going to wait until it comes in. I'm already down so much money. I'm just going to wait until it comes back down. So we want it to be directly above resistance, directly directly below support, not like a massive amount away from support or resistance, right? And that's really demonstrated here as well, right? So we don't want it to be gapping into support. We want it under support. So this is an example of it gapping into support or gapping into resistance. We don't want it to be opening into the previous low or into the previous high. We want it to be clearing the previous low or clearing the previous high. Does that make sense? All right, now let's go ahead and move on. We also look for gaps that end trends because they could be unbelievably powerful because they ultimately trap and shock the buyers or sellers. So here's a really good example of that, where you have a really established downtrend, right? You close right here the previous day, and then all of a sudden the next morning you open right here, right? Like think about how shocking that could be. Let's say you're in it short either from here or from here or from here. You know, you're going to sleep at night feeling good, your position is up, it's looking lower, everything's great, making money, and all of a sudden the next morning it gaps all the way up to basically right here, where it essentially just ends the downtrend. Like think about how you might feel waking up to your position now down hundreds and hundreds of dollars or thousands of dollars or hundreds of thousands of dollars. Think about if you're an institution who went short right here, for example, and all of a sudden the stock is opening up here, right? That's going to put pressure on you and everyone who went short to ultimately cover their position. And when they cover their position, they're buying their shares back. That's what gives prices the momentum to move higher, right? Or a gap that ends in uptrend, right? Let's say you went long right here and the price closed here the previous day. You're feeling good, you're making money, and all of a sudden it opens down here. Next morning, prices are down here. Aren't you going to panic? You're gonna be like, oh my God, I'm down, I'm losing a lot of money, and let's say it begins to drop. Let's say it starts to drop a little bit. And then you're like, oh my God, it opened, my position is more and more in the red, I'm losing more and more money, right? That's going to put more and more pressure on you to just cut your losses and sell. And that's what gives prices the momentum to continue lower. And this is why gaps that end trends or that shock buyers or sellers are powerful, because it puts those buyers and sellers in a position that they don't want to be in. It puts them in a position where they have to cut their losses or otherwise they're going to lose way more money. Alrighty. And we also like to look for gaps that are below green bars if we're going short, right? Or above red bars if we're going long. So if it's opening below a green bar, it is trapping all of the buyers from the previous day. And if it's opening above a red bar, it's trapping all of the sellers from the previous day, right? So a gap below a green bar is powerful. A gap above a red bar is powerful. And I know we kind of just went over theory, but let's look at some real life examples here. So let's take the PLCE. This is a gap from a couple of weeks ago, where on the previous day, we closed right here. And then the next morning, we opened right here. So let's see if it fits the criteria, right? We want a gap that opens below support. This is a support area. This is a support area. Yep, we're opening below this support area. We're also essentially ending this uptrend, right? We have this kind of mini little trend here. We're ending that trend, and we're also gapping below all of these green bars. Like think about it. Everyone who bought it this day or this day or this day, they're waking up to now prices moving against them. That's going to put pressure on them to cut their losses and sell. And that's exactly what happened. And we saw really nice follow through on this day. And we actually, dropped right into this prior support area. So this support area was kind of like target, right? We gapped right here. Next support area, we looked to the left. Next support area was target. And that's exactly where it dropped to. Really beautiful gap. And in fact, it continued lower. And this is the daily chart. So it continued lower the rest of the week. So you could see how powerful this could be even for like swing trading, right? Where you could find really powerful daily gaps that are ending trends, that are clearing support, that have room to fall. And you can even look for ways to swing trade it. Take a look at this gap right here. So we have this kind of like multi-week consolidation. We have a very clear support area right here. We gap directly below it. We gap directly below a green bar. And we also kind of have a setup on the chart. We're kind of consolidating here, consolidating. So we have a setup on the higher time frames. We have a breakdown, and we trigger that breakdown through a gap down. We open here, which like I said, below support. And if you look to the left here, we do have kind of a bunch of resistance. We have this resistance area right here, and we also have this pivot right here. But this stock just didn't care. It had so much momentum to the downside. I don't know what the news was, but it had so much momentum. This was such a massive catalyst for the stock that it just rip through all of that support. And it was just a picture perfect gap. And I remember I remember kind of writing this stock off in the pre-market because I didn't think it was liquid enough to trade. And then funny enough, it was, and it just produced such a massive move. All right. Now let's look at the NASDAQ. Let's look at the Qs real quick. And there was just an unbelievably powerful gap on it right when the tariffs really came out, where we topped here. We moved down, then we kind of bounced around. And I think a lot of people were saying that we bottomed on the NASDAQ right here. This is the QQQ. This is the tracking ETF for the NASDAQ. A lot of people were telling me, I was reading on Twitter, a lot of people thought that we bottomed, and a lot of people were going aggressive with longs thinking that the market bottomed. We had 3 green bars in a row, and I think we ended up gapping down the next day from here to right here. And look at the effect that this had on the chart. And by the way, we're gapping below 3 green bars. And notice how it's a downtrend. Or we have a high, we have a low, we have a lower high, then we have a lower low and a lower high, and then we gap down right here, and it just shocked all of the buyers who bought it the previous day. And you could see that, I mean, look at the move that it triggered here. And we literally just basically capitulated right after that. Unbelievably powerful gap, right? It trapped all of the buyers who bought it the last 3 days on this gap, and then it just completely tanked. Beautiful. And you could even say that this was kind of a higher time frame setup, that this was like a sell setup. This was a retracement into the declining 20 MA on the daily time frame, going over what those setups are and how to apply them with this gap strategy. However, I highly recommend watching my free 10+ hour trading course. It is genuinely better than most paid courses on the internet, and you can combine everything that you learn in my free course with a lot of my YouTube videos to really build the foundation for your trading. So I highly recommend going to my free course and learning about the sell setup that I just talked about, or the buy setup that I am about to talk about, and of course the breakout, the breakdown, the 1, 2, 3, and all of the other setups that I trade. So let's take a look at this APLD. We bottomed here. We went on a nice little uptrend. We have a rising 20 period moving average below price. We have a high here, and then we begin to pull back, and we have 3 red bars in a row. And then the next day, I believe we opened somewhere right here. So we opened above those red bars. We have an established uptrend. We also open above this resistance area. And I saw this in the morning, and this is actually a setup that I called in my mentorship community as well. And you could just see the move that it produced. I mean, take a look at this. Look at this move. And this was that day, but you could see even the next few days. I mean, this thing just mooned like crazy, but look at this gap, right? This gap right here. And that gap was the catalyst for this massive move to the upside. We cleared over this resistance area. We gapped above 3 red bars, and we also triggered a higher time frame setup. We had a very clear buy setup on the daily time frame. We have established uptrend, rising 20 MA, pull back into the rising 20 MA. We have an entry bar, and we trigger that buy setup through this gap, right? Where we gap up, we trigger the buy setup, and boom, we just go off on a rocket ship. And there was even a daily 1, 2, 3 here as well, where we had an igniting bar, we had a resting bar, entry over that resting bar, stop loss below, and it continued higher. So like I said, watch the free course, because like the 1, 2, 3, the buy setup, it's important to know that for this video. All right, but I am going to go over briefly what that is in a second. And I am also going to show you how to trade these gaps on the intraday timeframes. Let's look at Coinbase. This is another just beautiful, beautiful gap. Very similar to the APLD. We bottomed here. We moved up. 20 MA is now under price. Prices are respecting it. And we kind of had a little bit of a breakout here. And we triggered that breakout by gapping right here. We're gapping above this resistance. We're gapping above this resistance. We're gapping above the 200 period moving average. We're opening right here. You look to the left, we have plenty of room to the next resistance area, which is really like right here. So we have plenty of room to move higher. And let's take a look at the move that it produced. And Coinbase was just brilliant that day. I mean, such a nice gap, right? Above the 200, above all of this resistance. Beautiful setup on the charts, right? We have kind of a move up, basically a breakout. We have a breakout right here, and that breakout was triggered by this daily gap. All right, let's move on. Let's look at the UNH. And this was the company that there was a lot of news on it. A lot of people were talking about it on Twitter, and a lot of people were discussing how United Health, This was like, I think it was like $600, and you'll see where it ended up gapping to. But I think we opened right here, somewhere around there, right? So this thing, very solid uptrend. This thing looked like it was going to make new all-time highs, and all of a sudden it ends this uptrend completely. I mean, this is an extremely established trend to the upside. It looks higher. If anyone, any professional or retail trader looks at this chart, they're like, yep, that looks higher. This is an established trend. And we open right here below this pivot, right? We are kind of into a little bit of an area of support, but it just didn't matter at all, because you could see what happened directly after. On that day, we just had such nice follow through to the downside. And this is what happened afterwards, right? So this was that day, and you could see where the stock ended up falling to. This gap essentially ignited a brand new trend, because it shocked all of the buyers who were in it long, basically this entire trend higher, right? It shocked everyone. It trapped all of these buyers, all of the long-term investors, all of the traders. And you have to understand, when you have a really powerful gap like this that ends a trend or gaps below a lot of green bars, it's almost like a snowball effect of selling. Because think about it, right? It opens here, it starts to drop. Maybe there are some traders or investors that are like, hey, you know, this is a good company, I'm just going to wait until this moves back up, right? So it drops. Then it drops again. Then it continues to drop. And all of a sudden, their position is becoming more and more red. And it becomes a snowball effect of selling. And that's why these gaps are just have such a strong catalyst. And that's why they move with so much momentum. And we as professionals could take advantage of that snowball effect. We could take advantage knowing that those investors and traders are trapped and they're likely probably going to sell. So this is a really good example of a gap that's ending a trend. Let's look at Chegg. This was, oh my God, picture perfect. So we have a really established downtrend. I mean, look at the 20 MA. Look at how well prices are respecting the 20 MA. I actually have a video on my YouTube channel that teaches how to use the 20 period moving average. I also teach it in my free course. But so we move down and we have basically, you know, a little base breakdown. We have a little bit of a consolidation here at the lows. And it maybe there were some investors that thought that, hey, this thing double bottomed, I'm going to start buying here. And it started to move up. People thought that, hey, maybe Chegg bottom, maybe Chegg is about to move higher. They started to go long, and all of a sudden we opened like right here, directly below this support. We trapped the buyers who bought it the last 3 days, and we're continuing also the long-term trend. And it was just beautiful. And I remember trading in this day. I mean, it made me a bag. I don't remember, this was weeks ago. I don't remember exactly how much it made, but it was such a nice trade. And look at this. I mean, picture perfect. It closed at the lows. It closed literally at the lows of the day because it was such a powerful gap. It was continuing this long-term trend to the downside. It shocked the buyers who bought it the last 3 days. And also it triggered basically a sell setup break daily time frame. We have a sell setup consolidation at the lows. We triggered that setup by a gap down. Beautiful. And notice how we didn't gap down here and dropped. We gapped directly below support. Beautiful. Trapping all the buyers. Just picture perfect, honestly. All right, let's continue onward. We have the Yext. So this was essentially just a base breakout on the daily time frame. I think we opened right here or so. So we were clearing essentially this entire area of resistance. And the next resistance was basically all the way up here, right? And it didn't really shock any buyers or sellers, right? Because you look at the previous day, it was actually coming off a green bar. So it was already getting bought. It just essentially continued that momentum the next day. And let's look at what the gap ended up doing. And boom, I mean, insane green bar. Notice this is literally the biggest green bar on the chart. Look at all of the candlesticks. The biggest green bar was ignited from a gap where it essentially triggered a base breakout above resistance, and it actually cleared the previous resistance as well. It literally cleared it. It was such a powerful gap. Beautiful, beautiful. All right. And by the way, all of these charts, this is not me cherry picking. I do this pre-market scan every single day, not only for myself, but for every single one of my mentorship students that trade live with me every single day. We do this analysis every morning at 9 a.m. All right. So all of these stocks are stocks that were just on my personal scanner that we either traded that day and made money off of, or it was like on our radar and maybe we didn't catch that specific trade, but it was on our watch list. Let's look at the Chag, another great example here. Right here, we have a red bar. We closed right here, then we opened right here. Now, this wasn't that great of a gap, and I'll tell you why. We do have an established uptrend, right? Respecting the 20 MA, respecting the 20 MA. This was a really nice buy setup, by the way. Moved up, retraced, really nice buy setup. We had a nice red bar the previous day, so it started to get sold. I'm assuming the people who bought it started to take profits, and then all of a sudden it was gapping from here to right here. But it was gapping right into this area of resistance, and it was also gapping into the 200 period moving average. Now, it didn't care. It still went higher, but the point that I'm trying to make is not every gap is going to be a picture perfect gap. They're not always going to be perfect, right? Like A plus. I don't want to say they're rare, but you're not going to get them every single day. You're not going to get 5 a day. Sometimes you could still make money off of like B gaps or even C plus gaps, right? And we do that, all right? But generally speaking, you do want to trade the highest quality of gaps. Okay, so I just gave you a ton of different information to understand for how to assess the quality of a gap and what we specifically look for. But you probably are a little bit still confused on how to actually trade these gaps. Like, where do we enter? What do we actually do when we see a high quality gap on the daily time frame? And you need to understand that the gap sets the bias. And from there, once we know what the bias is, once we know what specific stocks we want to focus on, the ones that have the highest quality gap, once we know the direction, right, we go to the intraday time frames to trade that bias. We don't just buy a gap up, right? Let's say you have a really interesting gap up. It's clearing over resistance. It's trapping sellers. It's ending a downtrend. It's looking really good on the daily time frame. We don't just buy it. No, you need an intraday setup. So the gap sets the bias, it sets the direction in which we want to trade in, and from there we combine that with the intraday predefined simple setup, and we're about to talk about that. But I know people are going to ask me about timeframes. So in the pre-market, I'm scanning for gaps. I'm picking which stocks I want to focus on for the market open. And then when the market does open, as I'm looking at the daily chart and where the stock is opening, I'm looking at the 1 and the 2 minute charts from like 9:30 to 10 a.m. And I'm also looking at the 5 minute as well, closer to 10 a.m. Then from 10 a.m. to 12 p.m., and this is Eastern time, by the way, I'm looking at like the 2 minute chart and the 5 minute charts. And I'm also starting to look at the 15 minute chart as well. And then from 12 to the end of the day, I'm primarily looking at the 5 and the 15 minute time frames. Now, even when I'm scanning for new stocks to trade that day, I'm always looking at the daily chart first. I'm always assessing what is the gap, or is there a gap in the first place? And a lot of times, if there's no gap, I don't even look at the intraday timeframes. If the daily chart isn't interesting, there's no quality gap, there's no momentum, the daily doesn't really have anything to be interested in, I don't even go to the lower timeframes. I look at the daily chart, I assess, is there a gap? Yes, great. Is there a high quality gap? Yes, great. That's when I go to the intraday timeframes to look for a setup. Now, what setups do we trade? And it's really simple, guys. Like I said, just watch the free course. It'll teach you all of this. But we look for either a retracement setup or a consolidation. So this is essentially a buy setup or a breakout. That is exactly what I trade. All right. We keep it really, really simple, right? I don't like to overcomplicate my strategies. I don't like to use crazy indicators. I keep my trading as simple as possible. I think the simplest things in life are oftentimes the most brilliant. I keep it simple. So once I have the bias, to trade that bias, I either trade a retracement pattern, which is a buy setup, or I trade a breakout, which essentially is like a consolidation pattern. Now, I also want to show you a strategy that you can implement literally in the first few minutes of the day, because there are times where I will hop into a trade that has a really high quality gap right off the open, like the first 5 minutes of the day. Because sometimes these gaps, let's say you have a really nice gap down, it won't set up, it'll just go. And sometimes you kind of have to just jump into it to capitalize on the trade. However, we don't want to just randomly jump in. We still want structure for our trades, even if they're right at the open. But, you know, at the open, there hasn't been enough time to pass, right? If we're 2 minutes into the day, there's only 2 1-minute candlesticks. You can't really read a setup from that. You can't read a breakdown or a sell setup or anything. So what you can do is use the high-low pattern. And I think a lot of people call this the orb strategy, like the opening range breakout. Listen, I really don't care what you call it. I don't study the orb. Like, I saw that on TikTok and it was kind of similar to what I know as the high-low strategy, but doesn't matter. This is the strat. So what you're going to do is you wait for either the first 1 minute, 2 minute, 5 minute, or 15-minute candle to form. So the first one forms either 1 minute into the day, 2 minutes into the day, 5 minutes into the day, or 15 minutes into the day, depending on the time frame you're looking at. Now, if you're going long, right, let's say it's a bullish gap up and you want to go long, what you can do is you place your entry above the first candlestick, stop loss below. So you could put your entry above the first candlestick right here. Okay. And you put your stop loss below that first candlestick. And this provides structure. So you have a really nice gap up. You're noticing that it looks like it's about to pop. It looks like it wants to really get going and move to the upside right off the bat in the morning. Instead of just hopping in randomly with no risk management, no stop loss, no predefined entry, you now have structure for the trade. You put your entry below the highs of the first candlestick. You put your stop loss below the lows of the first candlestick. Now, the same thing applies when going short. It's just the opposite. You would place your entry below the lows. You place your stop loss below the highs. And right off the bat, I already know what you're thinking. You're like, okay, this is easy. Just wait for the first candlestick to form. And then if you're long, entry above, stop loss below. Going short, entry below, stop loss above. Makes sense. But which time frame do we use? Which time frame do we look at? Do we look at the 1 minute or the 2 minute or the 5 minute or the 15 minute? And ultimately, that is up to you. It really depends. Right? So my suggestion is if you do it off the 1 minute or the 2 minute, especially right off the market open, that stock could be so volatile that it's going to quickly stop you out. My recommendation is to wait for either the 5 or the 15 to form. You know, maybe if you want to be super aggressive, you could do it off the 2 minute where the first 2 minutes pass by, you have a 2 minute bar, and that's what you do the high-low strategy off of. My recommendation, I think a really good sweet spot is doing it off the 5 minute. And the issue with doing it off the 15, right, is you might end up having a massive 15-minute candlestick, right? And then all of a sudden you put your entry above, stop loss below, you have a really big stop. So now you have limited reward to risk. And then the upside of doing it off the 1 minute time frame is you might have a super small bar, right? So you have really, entry here, stop loss here, you have a really small bar, you have a really tight stop, you have a high reward to risk, but this thing might end up triggering, right? And then immediately stopping out. And then you end up losing a full R 1 or 2 minutes into the day because the stock is so volatile because it's right at the open. Does that make sense? So you need to find a sweet spot. My recommendation is just to do it off the 5 minute personally. But if you see a 2 minute high low where the first 2 minute bar is formed, it looks good. The stock is readable. It's not too volatile. It's an amazing gap. You feel like it's about to move. You can do it off the 2 minute and use the high-low strategy off the 2. Entry above, stop loss below if you're going long, or entry below, stop loss above if you're going short. So now we understand that the gap sets the bias. It gives us the direction in which we want to trade in when the market opens, but we don't just randomly buy or randomly short on a gap up or on a gap down. No, we need a predefined intraday setup, and that's exactly why we go to the smaller time frames to find that setup, whether that is a retracement or a buy setup or a consolidation or breakout, or whether that's a high-low strategy. If it's in the first few minutes of the day, we never enter randomly. We need to have structure in our trading. That's why we trade predefined, simple setups that are not complicated. They're easy to understand, and they're easy to know where our entry is and where our stop loss is, which allows us to easily manage our risk. Now, let's go back to the previous setups and gaps that we were looking at, and let's look at the intraday setups on those. So we have the APLD. Right? So this stock gapped up above 3 red bars over resistance. We already went through it. And let's look at the intraday setup that occurred on this day. And I actually distinctly remember this day because we traded this intraday setup. I called this in my mentorship group and we traded and capitalized on it. Now, let's take a look at it. So we have a very, very clean 5-minute buy setup, right? So what is a buy setup? That is a retracement pattern. where we have a move up, 3 red bars in a row. Great. Now we have a bottoming tail, entry bar. Perfect. Entry would go above that bar, stop loss below. Target is the previous high, and we actually surpassed that previous high. And if you look even later into the day, we kind of had another little buy setup right here, right? Where we moved up, retraced, moved higher. This one wasn't as high quality, but I definitely like this one where we kind of moved higher, 3 red bars in a row, entry above, stop loss below, and we made a new high. But the best one was really this one. It was just such a clean buy setup. And you might be thinking, hold up, for a buy setup, especially if you've gone through my free course, you're definitely thinking if it's a buy setup, then it needs to be close to or near the 20 period moving average, which is this line right here. I understand that there is some distance between price and the 20 MA. However, you need to understand that on a big gap, on a sharp gap up, it's going to take time for the 20 period moving average to catch up to price, right? Because it randomly just popped right overnight, and you could see why, you know, the 20 MA has such a sharp slope because it's trying to catch up to prices. So in the first like 30 minutes of the day, even first like hour to hour and a half of the day, you could use the 9 MA in conjunction, or the 10 MA in conjunction with the 20 MA, right? Like these can serve as your 20 MA in the first hour of the day, especially if it's a big gap either up to the upside or to the downside. But you could see we had a beautiful gap down or gap up that was bullish, triggering a buy setup on the daily here, above 3 red bars, above resistance, and we traded that bias through a 5-minute buy setup. Now let's look at the Coinbase. We already went over this gap, above resistance, above the 200, above a couple of red bars, triggering a breakout, has plenty of room until the next resistance area. Lovely. Now let's look at the intraday time frame, and we see that, what do we see? And I want you guys to kind of answer that. I want you to pause the video and really think about it, but I'll tell you the answer. We just have an amazing uptrend where prices just are respecting the 20 MA. And right off the bat, we have a nice breakout right here over the highs, stop loss under the lows. That kind of chopped around for a while until the 20 MA caught up. And then as soon as the 20 MA caught up right here, that's when it decided to really run. So you could have even traded it as a breakout here. With your entry above the base, stop loss below this tail. You could have even put your stop loss below this base if you wanted a tighter stop. And in theory, if you want to be super aggressive, we have somewhat of a 5-minute 1, 2, 3 here, where we had a igniting bar, doji bar. You could have even put your entry above that doji bar, stop loss below if you really wanted a tight stop, but that's super, super aggressive. And then even here, we got a buy setup and buy setup again. And you can see how well it's respecting the 20 MA. Just beautiful, beautiful gap and beautiful uptrend on the intraday time frame where you could have traded either a breakout here and then you saw it chop around for a bit, or you could even enter the breakout here, or you could have traded as a buy setup here. Just a bunch of different setups that you could have traded on this stock, right? But that's the idea. Gap, then you go to the intraday time frames and you find a setup. Let's look at this. Same exact thing on the UNH. And this is actually a great example. We already talked about the UNH. This is a great example of a high-low where you could have, right, you have this first 5-minute candle that formed. You could have put your entry below that first 5-minute candle, stop loss above the first 5-minute candle, and you would have capitalized on this move lower. Now, it would have been a really big stop. That's the only issue. So what I would have personally done is I would have traded this as a 5-minute 1, 2, 3. Igniting red bar to the downside. We have a resting doji bar, entry below that 1, 2, 3, stop loss above. And like I said, watch the free course. I keep saying it, but all these setups, it's important to understand it. I teach the 1, 2, 3 in that free education, so watch it. But this could be a nice 1, 2, 3, and it continued lower. Just amazing trade, honestly. So you could have done it as a high-low or as a 5-minute 1, 2, 3. All right. So bearish gap down, and we traded that bias through those setups that I just mentioned. Let's move on. Chegg. Let's look at the Chegg. We already talked about it. Beautiful gap down below these 3 green bars, continuing this long-term trend below support. And let's look at the intraday setup. And we have just a really clean breakdown. We move lower, we consolidated. Check this out. You know what this is right here? This is what's called a shakeout bar. This is called a breakout failure, where notice what happened. We dropped, we began to consolidate. From there, we attempted to move higher and failed. And then we got the move lower. Just beautiful, right? You could see that topping tail the buyer stepped in, tried to bring prices higher, and then the sellers were like, nope, this is bearish. There's a bearish gap. You're not bringing it higher. And they brought prices right back down. So it was like a failed breakout. Either put your entry here, stop loss above, right? So entry below the base, stop loss above, or you could have, even if you want to be aggressive, like I remember trading this, I entered below this doji, stop loss above, which obviously isn't textbook, right? For a breakdown, we want it to trigger underneath the base. As soon as I saw a breakout failure on a really bearish gap with a really bearish base breakdown on the 15-minute time frame, I was just like, yep, I'm hopping in. And I think I went to either the 5-minute chart or the 2-minute chart for a much tighter stop and a much tighter entry. Let's move on to the next. We already talked about the gap above resistance, triggering this base breakout. And let's look at the intraday setup. And we have just such a clean, this is the 5-minute time frame, such a clean high-low. Entry above, stop loss below, and look at that move. Wow, just insane. And then it consolidated. Literally, it consolidated for a while right here. And you could have traded this as a breakout. Entry above the base, stop loss below, and capitalized off this move, right? And then this would have been the target, which basically that's where it got to. All right. Do we have any more? Yes, we do. Let's look at the Chegg. This is actually a pretty recent trade. This is the one that I said it wasn't that good because it was into resistance. But let's look at the intraday setup here. And we kind of have like a 1, 2, 3 slash breakout. So I remember I called this over this candle, stop loss below, and we caught this move, but then there was also a really nice 5-minute buy setup. So a lot of my students and I, we caught this move off this breakout, but then you could have even traded this 3-bar pullback, nice entry bar as a 5-minute buy setup, really close to the 20-period moving average, entry above, stop loss below, and you would have literally just caught, number one, this move that it pulled back, one more buy setup. And then funny enough, it had a base breakout. So entry above, stop loss below. So you're seeing this like on literally just a Chegg on this uptrend. How many opportunities did you have to enter it? You had this initial opportunity, number one, 5-minute buy setup, number two, another 5-minute buy setup, number three, and a 5-minute breakout. 4 potential setups. You can even say 5. You could say this was a buy setup as well. That's 6. Right? And by the way, this was like a low quality gap. This was like maybe a B minus C plus gap. But even on a B minus C plus gap, you see so many potentially, interesting opportunities on the intraday to trade that bias. Before I do a summary of the entire video, this chart essentially explains why we focus on gaps. I want you to identify the 2 biggest candles on this chart. Literally pause the video and find the 2 biggest candles. And if you did that, you would see that it's this one and this one. And both of those candles were ignited by a gap where we have a really nice uptrend right here, respecting the 20 MA. We move up, we consolidate into the rising 20-period moving average. We have a really nice daily breakout. That breakout was triggered by a gap and boom, it just mooned from there, right? And we did have resistance to the left. It didn't care. It just ripped right through it. Looking at this one, another really nice established uptrend, higher highs, higher lows. We moved up, had a nice buy setup into the rising 20-period moving average. We triggered that buy setup through a gap up and boom. And by the way, we had resistance as well to the left here. Did not care and it just ripped right through that resistance, right? And by the way, I always like to look to the left to find the next resistance area. So in this case, the first resistance was right here, which it cleared that. And the second resistance was right here, which it literally it cleared that as well. But usually I like to use resistance areas and support areas as my target for trading gaps and trading the intraday setup on the gap. Now, quick little summary, guys. We learned exactly why we trade gaps. They have way more momentum. They have a catalyst behind its movement, and they just move way more than non-gapping stocks. 90% of the time, I am trading in the direction of the gap, right? There are exceptions to this. There are times where I'm going against the gap, but I'm not going to talk about it in this video. We already talked about a ton of different stuff. One more thing I should note is that if you have a gap up, right, we are looking to go long. But let's say we have a gap up and it starts to sell off and it starts to drop. I just don't focus on it anymore. I don't trade it short. I just don't focus on it. So I don't like to trade the gap fill. I trade in the direction of the gap. And if it starts to fill the gap, I just ignore it. Same thing if it's a gap down, I'm looking to go short. That's my bias. But if it starts to move up, most of the time I don't focus on it anymore, right? We learned about how to find gaps in the pre-market, all the different websites. I like to use Thinkorswim and I do use Market Chameleon at times. We check the price and from there we check, is it clearing above resistance? or is it clearing below support? Is it shocking any buyers or sellers? Is it triggering a breakout or a buy setup on the daily time frame? Does it have room to the next resistance area, right? We talked about what we look for when it comes to support and resistance requirements. And then from there, we talked about just a bunch of gaps and what we specifically look for in gaps. And remember, we want gaps that are powerful, that are shocking buyers or sellers, that are making buyers and sellers uncomfortable to be in the positions that they're in. And that's where the biggest opportunities lie. It's very, very important. And the final note I would say is that always remember, we don't trade the gap. We need a setup, right? We can't just enter randomly into a nice gap up. We need an intraday setup, whether that's a retracement or a consolidation or a high-low strategy. Make sure you watch my other videos and my free course as well to learn about these setups and begin applying them to gapping stocks. Hopefully you guys enjoyed this video. And if you want to trade live with me every single day and have me take you under my wing, teach you from A to Z, and have you learn the skill set by actually doing it with your mentor, I have a mentorship program where I personally scale and coach traders from $0 to $10,000 to $50,000 a month with trading. This is a serious program for students who want to become full-time traders, that want to have potentially a career change. So if that sounds like you need a hands-on personal mentor by your side, you could apply in the description of this video. It's a very selective and exclusive mentorship because I only like to work with serious traders. So please be detailed with your answers. But if that's you, feel free to apply and we'll see if this is a good fit. Make sure to like, subscribe, and leave a comment if you found this video valuable, and let me know if this actually helps you. Apply everything that I taught in this video and see where it takes your trading, and then come back to this video and let me know how you've been able to progress. I will see you on the next video. Thank you for watching.